So for our first panel this morning, I'm really looking forward to the big technology debate, getting the most value out of your technology investments. So I'd like to actually invite up to the panel up here, David Rukshin, Senior Vice President of D.E. Shaw, Michael Beller, Chief Technology Officer at Tradeworx, and Nigel Young, Chief Technology Officer at Spot Trading. Please welcome them up to the stage. As everybody's getting seated to their appropriate seats, just wanted to give you a quick fun fact about everybody up here. So David Rukshin road races and flies airplanes for quick thrills. Maybe we can expand on that one a little bit. Michael Beller learned to speak Hebrew at the age of 40. Very impressive. Nigel Young came to the U.S. in 2002. A huge soccer football fan, regularly plays five-a-side. Middleborough FC is who he supports. So welcome. And after those fun facts, I really wanted to give you each an opportunity to do your own intro. So if you could, Nigel, if you want to kick us off.
Can you hear me? I'm Nigel Young. I'm CTO of Spot Trading. Spot Trading is a proprietary trading firm based in Chicago. We're about 130 people. Primary business is US equity options. Although recently we've diversified into future options and single stock market making. My responsibilities are for QA and software development and the IT function. I've been at Spot for 7 years now.
Hello, my name is Mike Beller. I'm the CTO of Tradeworx. I've been CTO of Tradeworx since it was founded in 1999. Tradeworx is a hedge fund and high-frequency trading firm. We also run a technology subsidiary called Thesis Technologies. We trade primarily in US equities, and our technology subsidiary Thesis provides high-performance trading technology to a group of firms which collectively trade about 5% of equities every day.
David Rukshin, I'm Senior Vice President at DirectEdge, Shaw, responsible for infrastructure platforms for quantitative trading systems. And we're a hedge fund, been around about 25 years, primarily trading quantitative strategies, among others, trading global equities as well as many other instruments around the world.
Thank you very much. Sorry about that. So really wanted to take the chance for this panel to really focus on the increasing costs from technology. As we all know, technology, from a volume standpoint, volumes are up, but executed volume is down. So really wanted to take as Commissioner Chilton had looked at the audience, and know we have a broad breadth of people in the audience today. So really wanted to open up the discussion here, focused on the challenges that each one of these firms has within the marketplace, looking at the increased demand of technology, whether it be hardware or software, as well as the increased cost to support that. Commissioner Chilton talked about the cheetahs out there, right? So we all have to support the demands of what everybody perceives to be cheetahs. So really wanted to open up to see everybody's sort of feedback on how they approach technology and kind of the demands that they're seeing within their own firms. So who wants to take this first?
I can go. Certainly technology demand has, I would say, picked up significantly over the last few years. For us, we are primarily looking for ways to provide technology not just for the fast trading, but for the research side. And that's probably one of our biggest areas where we're seeing a lot of demand, and compute resources, storage, highly performing storage are really big areas where we're working on. Software optimization is always a thing. So that's, I would say, those at the top.
That's great. Anybody else want to add to that?
Yeah, sure. We're a US equity options trading firm, so the market is highly fragmented. The cost of DMA to all of the options exchanges is very high. What we're focusing on is building our own internal proprietary application. We focus on reusability of our strategies through new asset classes and build algorithmic frameworks so our development efforts are well spent. A key area that we've been focusing on this year is latency. I think we'd probably describe us as a hippo rather than a cheetah. At the beginning of the year, we've overhauled our latency. We've implemented latency measuring technology that enables us to capture network packets and certain nanosecond timestamps and build up a data set that ensures that we can see what we're doing and what our counterparties are doing in the trade. That process or that technology lets us create a data set so that we can really understand what's going on. That enables us to target our efforts at the most impacting points, or measuring twice, clicking once, so to speak. So we're using analytics and advanced technologies to help make sure that we're working on the correct things.
Great, Michael.
Sure. So at Tradeworx, when we entered into trading, it was in sort of lower speed stat arb trading, but over the years we've migrated, in order to improve our stat arb trading, we migrated to more and more advanced technology until we kind of got into to HFT almost as a consequence of having to constantly improve and invest in technology. And I think one of the basic facts about information systems is that you've got storage, transmission, and computation. And at any given moment, your biggest bang for the buck might be in one of those areas. So, when you're trying to compute over a lot of information, you might have a problem with storage, and you might be focused there, and you can get a lot of gains with ROI there. I think in the last few years, the biggest area for our firm has been in transmission, and whether it's expanding the pipes, as it were, to from 1 gigabit to 10 gigabit, and then multiple 10 gigabits to 40 gigabit, in order to keep up with the inrush of equities information or options information, as Nigel was speaking about. That's been a huge area of investment, and more recently, the competition surrounding sort of the New York-Chicago corridor for trading has caused us to also invest in the area of low latency microwave communication. So I think we've found that always invest where you can get your biggest ROI, and maybe in the last few years that's kind of where the rotation has been, but maybe next year the rotation will be into computation.
And I think that's a really important point you brought up about focus, especially when you're talking about wave technology, whether you're talking about storage, whatever your sort of your business needs are today. I'd like to just talk, I know we had a discussion as a team here, talking about everybody's approach to dealing with these type of new technologies, right? So whether you're going to go outsource or you're going to go in-house. And I think this panel here has a unique breadth of experience when you're looking at how to approach that focus, right? Are you going to go to a vendor first and look at how the cost there, or are you going to take it in-house and try to sort of tackle it there? I know Tradeworx has a unique approach there, so maybe you could talk a little bit about that as well, Michael, and then maybe give the approach from the other shops as well.
Sure. I guess the issue was that it seems like there's always more and more investment required to keep up with the latest technologies. And as early as 2007 and 2008, which was when Tradeworx built its first fully co-located trading system to support its stat arb business, and then, as I mentioned earlier, as a consequence got into high-frequency trading. But it became clear that the constant expense of trying to keep up was not going to stop. I mean, initially we could only afford to be in 1 or 2 colos, and then it became clear that we needed to be in 6 colos, and initially we had gigabit links, and then it became clear we needed 10 gigabit links. But early on it was clear that what was going on was an arms race that had really been triggered in a lot of ways by market regulations, decimalization, and then the Reg NMS in the case of the equities markets, where it essentially caused everybody to really have to be able to trade on every trading platform and therefore expend the money to connect to every trading platform in a high performance way. Our response to that was to say a small firm, and Tradeworx is a relatively small firm, can't necessarily afford to do all that investment by itself. We had some excellent technology and excellent technologists who knew what to do, but in order to support the cost, what we decided was to make the technology shared among many other firms. We created a subsidiary called Thesis Technology, which would make top-tier high-performance trading technology available to multiple firms, and in that way we turned what would otherwise have been a cost center, and possibly an unsupportable cost center from a profit-loss perspective, into a profit center. And that's kind of our approach.
Great. How about D, Sean?
We, being relatively large, I think we generally have a bias towards in-house development. Also, having the benefit of a fairly large in-sourced offshore development center really does help. We do occasionally go out and look at third-party solutions, and we've brought them in-house for various technologies over the years. The trend tends to be for us to revert back to in-house. We believe that that's a lot of our competitive advantages in software and how we approach problem solving there. So we have that bias. That's not to say we'll never go out and buy. But yeah, we always worry about competitive advantage not being gained or being potentially lost by sharing technology with someone else.
Yeah, we're in the same boat as that. All of our trading systems we built in-house. Over the years, we've had various third-party applications in there, and ultimately that's always been a time and market play. We end up pulling them out. What we do focus on, though, is finding best-of-breed libraries, open-source technologies, things like Folly, things like that, to make the development process easier. We also outsource things like monitoring and parts of the chain that we don't see as that much of a value add strategically. We've also started leveraging cloud computing relatively extensively, but in areas that are not key to the business. So things like backups, data storage, things like that, we're shipping off to the cloud. We've gone with a hybrid cloud approach, essentially keeping the control of the cloud on site, and we send our data off to various cloud providers. So those are some of the things we're doing to just help us keep up with the arms race.
That's great. I think it's interesting. You bring up a good point. Is kind of the cloud computing, right? What does that mean to everybody's business here? When you talk about speed, I don't think cloud computing is definitely in the same conversation. But when we talk about, as the gentleman has been said previously on the question, regulation, right? And regulation is requiring us to do as an industry. Storage is a big part of that. So maybe you guys could talk a little bit about your approach to the sort of regulation environment and how that is changing the demands from a technology perspective. It obviously swings resources away from the trading side and kind of the side that makes money, if you will, back to the requirement of what it takes to sort of keep the lights on from a regulatory standpoint. So I think, David, you want to talk a little bit about from a regulatory standpoint?
Sure. Having been a quantitative hedge fund for many years, we've always been kind of at the forefront of accepting a regulation into our business practices early on. We became registered much earlier than had been strictly required. So a lot of these regulations, while they're new to me, they're not quite as new to us. And by trading in a very wide variety of markets, we've had a very large range of regulations that we've had to deal with. So it's certainly an issue that we see taking more and more of our resources, but it's probably not quite as big of a hit for us as it may be for smaller or new organizations. But it's always continues to be a concern. look careful as to whether we're spending more than we need or less than we need, and hopefully we never spend more than we need.
Got it. And Michael, how about from your perspective?
From our perspective at Tradeworx, our biggest concern is that regulation and regulators will make missteps out of not maybe knowing all the facts. So we had a great concern at Tradeworx, for example, that some adverse regulation like all orders have to stay in for 5 minutes or something could come out, simply because there seems to be a lot of ignorance about what actually is happening in low latency trading. And that's a really big concern for Tradeworx. We went so far as to participate in an RFP that the Securities and Exchange Commission put out to obtain an information system to let them view all of the feeds. And we participated in that RFP. We eventually won that RFP and provided a system that lets the Securities and Exchange Commission see all of the direct feeds, which, believe it or not, they had no ability to do, at least on a large-scale basis throughout the commission. And we were actually very pleased with that. The goal really there was to make sure that the regulators had the ability to see the markets the way we see the markets, because I think that when they are able to see as clearly as they can what's going on, and if they have the will to dig in and the right types of analysts who understand the markets on staff, they will make the right decisions about what needs to be done to regulate the markets. And so our view and our approach is maximum transparency. But the best thing is for the regulators to be able to see absolutely everything, and then they'll make the right decisions, rather than just being vulnerable to whatever the axes of the people who decide to comment on the regulations are.
Yeah, no, taking the exchange hat on, transparency is always key from our perspective. It becomes very difficult in this environment when, as we started off talking about, the actual order volume is going up, fragmentation continues, the marketplace as a whole becomes a lot more difficult to sort of manage all that, especially getting around the consolidated audit trail. I think there's a lot of opportunities for everybody in this marketplace to sort of benefit from that. Although it's going to be a large lift when it comes to the industry as a whole, I think that transparency is going to be fantastic. And then how about from spot trading?
Well, we're a broker-dealer, and the SEC regulates us in our primary business, so we've grown up with heavy and tight regulation. How we've tackled it, we've built a culture of compliance internally. We have a robust compliance team. We really don't suffer from the wash sale issue that was talked about on the opening remarks. Things we're focusing on this year is 15C, obviously puts a lot of potential latency in front of the system. We're working on innovative ways of ensuring that it doesn't add too much latency to our order flow. We've also built an analytics framework that captures every transaction we do in the market. So we've got a very robust audit trail that enables us to really dig into what's actually going on. That provides us another tool for auditors when they come in. We've also shipped off some of the audit trail to the cloud, so we can access it very, very quickly now. Historically, we would have to potentially restore backup tapes and things like that, but we don't have to deal with that anymore.
That's interesting. I think one other topic, if we could sort of delve into the sort of multi-asset class and the challenges that we have from a technology perspective in supporting those multi-asset technologies, if you will. Every exchange has its different protocols to connect to. Every marketplace is a little bit different, whether you're going global or just regular multi-asset class. And maybe you individuals here could talk a little bit about that approach and the way in which you sort of see, kind of what's at the front of your mind when you're looking at multi-asset class and how to sort of push that forward with your business.
We've been in the multi-asset business for a very long time. So again, perhaps it's a little different for us. From a software perspective, it's all about a modular approach. Something that, write something you can reuse as much as possible. adjust, and they're certainly concerned that different exchanges will begin to change formats faster than they have in the past, and you got to keep up again. This goes back to in-house versus outsourced story, and being in-house developed. This is always a concern, but if you have a team that's been doing it for a while, it seems to get easier, which is nice. But the data flows from multi-asset is also an issue, right? I mentioned storage, for example. We talked about cloud. The volume of data that you get is ever increasing, and the more asset classes you're dealing with now, for research it becomes even more number of transformations you may want to do to really do research on it, and how to deal with that explosion of data, both from a performance and access perspective as well as ballooning costs.
I think we've had a similar experience. Over the last few years, we've expanded to new asset classes, so we've had to expand a system that's really designed for US equity options into futures markets, commodities, markets like that. And it's been challenging. We found our back office systems weren't really flexible or extensible enough to deal with it. So what we're doing now is we're in the process of rewriting a lot of our back office processes, things like assignments, expirations, clearing, interaction. We're in the process of rewriting using Python with some open source technologies such as Tornado Web Services, HTML5, Twitter, templates, things like that. We're using to rewrite our back office processes. But it's challenging. Symbology is difficult, especially when you have brokers in the middle of it. Matching market data, symbology across brokers, all the exchanges is somewhat of an uphill battle. So we're in the process of rewriting our system to be a lot more flexible and extensible for the future.
Yeah, I think jack of all trades comes to mind when you're thinking about multi-asset class. Especially coming from the exchange side of things, we're in a constant race when it comes to improving our technology, improving our our market data, improving our products and services. So it is to all of your points here. It is a constant communication with the exchanges, and I know that communication that's pushed out by the exchanges is fluid. But I think that relationship with the exchanges is very important to anybody who's looking to within the trading space to ensure that you have the communication that's set up for any changes that are coming around from the exchange side. Although all the from the U.S. equity side of things, they're actually filed with the commission. But when you talk about multi-asset class, the changes are fast and fluid. Whether it be a new market that pops up and sort of evaluating that and how you should sort of approach that. So maybe you guys can talk a little bit about that effect. I mean, we've seen, you talked about multi-asset class, but as new products come up and how you kind of evaluate the markets, beyond new products, but new markets, I guess, with the fragmentation that's out there across multi-asset class, how do you evaluate the markets and what's your kind of approach to those new markets? Maybe I'll put Mike on the spot here.
Okay, so to make sure I understand the question, you're really asking how do we evaluate whether we enter a new market or a new asset class?
Well, both the new market as well as a new exchange, whether it's a new dark pool, a new ATS, or whether it's connecting to a new market in general.
So both of those are, there's going to be a big aspect of it that has to do with what is going to be the cost to do a really good job of connecting to that platform and what's going to be the benefit. So if a new US equities platform comes up pretty much because of regular mess, we have no choice. Our traders demand that they have direct connectivity to every exchange in order to be able to do the type of trading that they need to do. So that is actually one of the things that's driven the fragmentation of the equities market is regularness forces everybody to connect to every exchange if they want to do optimal trading. That having been said, even there you might have a choice. Does one connect using FIX and therefore be able to reuse a market access software component that one already has. Does one connect using binary, which is almost always a unique new protocol that is different from every other one, and now you're going to have a guy who's going to be fixing that every few months when it gets updated. So I guess it's another issue where you have to kind of go for the maximum bang for the buck. If it's a platform that is very much in demand and a lot of trading is going on it, you spend the maximum spend and you go and get the 10 gig cross connect and make the binary connectivity. But if it's something new, maybe you try the lower cost connectivity initially and the lower cost ways of connecting to it, and then see what develops, and then invest when it becomes valuable to the system.
Right, I think as we'll see in the vendor fair today, there's a lot of solutions out there to sort of try, especially international markets. I know we have some panels talking on that. But it's a dynamic marketplace where you do have that flexibility to start off with vendor, as you're saying, and then go to sort of proprietary. And how about from D. Shaw? I'm sure you already have those connections going, but.
Well, new venue comes up, we need to figure out what to do much the same. And I think the philosophy there is very, very similar to Tradeworx. You got to figure out what you're going to get for what you're going to spend. In some cases you have to spend. Most of the time it's something very new, and we tend to be conservative firm from a risk perspective. So you dip our toes in it and do a lot of analysis and figure out if that's the place we want to be, if our systems are set up for any regulatory implications that might be there, and really do thorough analysis, because beyond initial costs, there's always the ongoing maintenance that tends to be higher than you hope.
Yeah, no, that's a great point. I mean, you're anticipating, well, hey, if I can connect to this market, I'm going to make X number of dollars. Okay, but what's the carry cost from a regulatory standpoint, from the ongoing fee, reoccurring fee for the connectivity going forward? It's a very good point.
Yeah, from my perspective, it's definitely a cost-benefit analysis that we do. We also look for venues that really extend our existing business. We're pretty good at price volatility, so we look for volatility type products. We have a pretty good analytics framework that enables us to, on the equity option side, view what we perceive as edge in the marketplace, and we'll calculate the exchanges that have the best edge. Obviously, there's incentive structures on the exchanges, such as rebates, that help that decision. Also, some of the consolidations been going on, NY4, getting ICE, CBOE, DirectEdge there. The consolidation process helps us get into these exchanges at relatively low cost, because we can build just one colo rather than 3 or 4.
Yeah, and just to expand on that, when you say consolidation, you're sort of saying consolidation within data centers, right?
Yes.
Yeah. And that is from an exchange standpoint there, when you're looking at a data center and where you're going to go, it's a big part of it, right? I mean, you want to have the best proximity that you can have, but it's the restaurant effect, right? The more exchanges that are there, the easier it is for you to connect. As you've seen, I think in the news, a lot of the exchanges are now going to 350 CERMAC for their backup data center. And I think at the end of the day, that will make the ability for all participants to have, with quotes, easier access to backup facilities.
Yeah, I think both of those things are really huge challenges in our space. And I guess I mentioned earlier that storage, processing, and transmission are part of every information system. And like David mentioned, on the storage side, cloud, and Nigel mentioned it too, cloud is probably not going to go away. We're all dealing with more and more and more data, and the only reasonable way to analyze that data, it may not be that useful when you need to make a microsecond trading decision, initially for right now, but certainly in terms of doing research, expanding into the cloud is going to happen. And I think at the low latency end, there's always going to be more technologies you need to address and apply in order to be successful. And the real focus is, what's the one that's going to, today, make the biggest difference in my latency of my trading platform?
That's great. So I'd like to open that up to to the audience. Do we have time for a couple more questions? Okay, great. Any questions out there for the panel? Got one in the back.
Thank you. Have any of your firms seen pressure from the business side to either consolidate the number of destinations you're going to, trading destinations, or limiting things on a really cost-benefit basis? For example, Morgan Stanley announced this last week that they're going to cut back the potential number of ATSs or destinations they're doing business with.
We see the opposite. We have constant, Tradeworx has this combination of a trading operation and a technology operation. The technology operation also serves many other customers who trade on that trading platform, and they're constantly interested in more and more places to trade. So I think that maybe that's just because of our model where we have the shared platform among multiple customers, but no, there's real excitement about being able to do more and more cross-asset trading. That's what we're seeing.
Yeah, we're in the same boat. There's a huge demand for new assets, new markets. Like we said before, it's driven off the cost benefit, obviously.
Yeah, we see it very much the same.
Thank you. All right, great. Any more questions out there?
Oh, a question in the end?
Yeah, thanks. You mentioned that you're farming some of your technology out to clouds. What rough percentage of your overall technology base is latency sensitive equipment that's obviously going to have to sit in exchange colo versus is farmable to a cloud, whether that be a public cloud or your own private cloud or some other non-latency sensitive data center? Rough percentage.
In our case, it's more along the lines of function. So what's going on is research is migrating more and more into the cloud. Trading is just as co-located as it was before. There's nothing we can do in low latency trading yet that directly in real time involves the cloud. So it's a little bit hard to say what that is. If you were to look at instances and storage, I would say we got a lot more storage in the cloud than we have in the colos. Probably on average we do more computation still in the colos than in the cloud.
Yeah, we're the same thing. I think of the exchanges and the co-location facilities essentially kind of the first step into the cloud where, for us, we're offloading all of our management of servers, of power, of cooling to the exchanges. So it's a mini kind of financial cloud as I think about it. On the higher frequency side of things, like servers and things, we really haven't really contemplated putting those into a cloud. I know NYSE had a solution out, and they pitched it at us, but we're not ready to give up that level of control at this point. So we're focusing on areas like analytics, backups, monitoring, anything that isn't really frequency dependent.
For us, we're probably much more in the cloud space, primarily the internal private cloud, whereas obviously low latency, sensitive pieces of the trading system, obviously in colos and are not likely to be cloud enabled anytime soon. The great majority of computation, as well as parts of the trading systems, do run in the internal cloud, and have been for a couple of years now. And we've been pretty heavily investing and expanding in that space. Public cloud, is harder. The amount of data I keep talking about is huge, and you get killed cost-wise if you only put a copy out there. So I don't really have a great solution for that just yet. Love to hear if anyone has one. But internally, we've been building out a cloud for a good amount of time, and just continue to move in that direction. You asked for a ratio. don't have a good ratio, but I would say, probably 10 times more compute internally in the cloud than in the colo.
Okay, great. Can everyone just give a big round of applause for the big tech debate?